But suitability really comes into play with variable policies, because you can get yourself into trouble as an agent if you recommend for someone to go and assume a certain risk tolerance who shouldn't really be taking that risk tolerance. So the variable life, like a straight variable life, a variable whole life essentially, it has a minimum death benefit and it has a level fixed premium that's always the same. The only thing that fluctuates in it is the cash value based on where you're investing that money. Now, a variable universal life, it has a lot of the same tenets as a universal life. So it can have different, you can fluctuate on the premium. So you can increase the premium. Remember, on a universal life, you can decide to pay a little more some months. You can pay a little less some months on what your target premium is. There's a minimum premium, which is the minimum just to keep the policy in force in that time. And then there's a target premium, which is the amount that you'd want to put in to keep the policy in force for your entire life, or to whatever date you're trying to keep the policy in force for. So with the variable universal life, you can actually adjust the premium that you're paying up and down. And also, if there's enough money in the cash value, you could even potentially skip a premium payment date.